All right, welcome to our seventh episode in the Riskology webinar series. This one I'm really passionate about because we're going to be going over row crop risk management practices, how-tos, things like that. So I'm very excited for this webinar series today. Let's get started. So on the first slide here, I'm just going to talk about, it's a disclaimer just based upon none of what I'm going to talk about as a recommendation directly. These are just some examples of how to look at things on your own operations. Hopefully they can fit quite well for your operation, but like I said, no true example. I'm using fake numbers, things like that. That would be kind of relevant today. So first, I want to explain what just row crop risk management is and what we're going to look at today. We're going to manage price risk. We're going to look at yield risk, margin risk together. We're going to coordinate things like production and insurance and marketing decisions all into one facet to kind of work well with one another and have some fluent organization that work well with each other. And we're going to replace emotion with structure and discipline. And then we're just going to be focusing on things like profitability and not just what price we're at and if that's a good price to sell. So on the session roadmap, I'm just going to walk through this itinerary here going forward. It's going to be timeline. Then we're going to talk about cost of production, production estimates, logistics, corn versus soybeans planning decisions, talk about risk tolerance levels on how you operate independently, and then talk about building out a plan. And I'm going to have a few examples, kind of a deep dive through there. That's where the majority of this time is going to be being spent inside of my mind, looking at what building a risk management plan looks like. So let's start with a timeline, just through one single year on how we look at and need to know for operations of risk management practices. So start of the timeline would be the spring timeframe. We're going to have planning decisions. We're going to have then spraying decisions and logistics throughout the summer, taking care of the crop. Then you're going to have harvest. And then you're going to be selling cash corn in the fall, for example, or putting it in the bin, deciding on what you do. So when I look at marketing and tying that all together with that logistical timeline of how your independent production practice works, I'm going to be looking at right before planting season. I want to view my cost of production on that operation. I'm going to see what I'm planting, corn or soybeans, what I should plant, get that all aligned. I'm going to have most of my input costs all set during that time frame. I'm going to know quite a bit about my operation. Once I get it planted, I know how much I planted, how the crop's starting, how it's looking as I get out into the field and start spraying it. Typically, that's where we start to quickly get worried about things like weather. We get a weather rally. We put a little premium in the market. It gets very volatile in the summer. It creates nice selling opportunities for the crop that you're growing. And then once we get almost to harvest, but not quite, kind of the August timeframe, then we look at things like how do we manage carry in the market? If I put corn in the bin and store it, how do I look at spread opportunities using that and manage my space like an elevator, not just gambling on, I'll put it in the bin and wait for price to go up on both basis and futures. And then after that, we're going to look at setting basis in August, selling cash corn, locking that in, and then harvest and sell that corn in particular. And after harvest as well, once I have that in the bin, there are some nice opportunities in the winter time frame for setting basis as well. So from a timeline perspective, that overall is kind of how we're going to view your year in review. So on the cost of production tab, let's get started with that because it's very important to know where you're sitting before you start working on what marketing plan works best for you. And a few things that sum up the cost of production. These are the basics that all of you have to go through and know to grow a crop anyways, but it can be very difficult to track to a penny. But we're going to be looking at things like seed cost, fertilizer, land costs, fuel, labor, interest and overhead, things like that. And when I look at a few of the example cost of productions of where to start, what to track, how to benchmark myself. These are 3 links. If you need the links, please contact us or I'll put them in the description down below. These 3 links, I think, provide fantastic resources to a metric to follow cost of production. My favorite in particular that I find is the most relevant and most accurate is going to be the Iowa State production budgets. And just a quick reminder on that, this is kind of how their sheet looks. They're going to be breaking it down in many different crops and crops following different crops. But in a normal rotation like this one, it would be corn following soybeans. They're going to break it down on fixed and variable expenses. They're going to work their way down the list. I normally like to use the middle column because that's kind of an average, and I think it represents our average customer quite well. If you use just above 200 on a normal yield or a good year, I think that is a very accurate type break-even level if you start viewing those. So about $911 an acre cost on a 211 bushel yield, going to give you around a 432 cost of production. Remember, when you're using this sheet, add both sides up together for those columns. So if you're looking at, fixed pre-harvest machinery and variable, you've got to add those two numbers together, the 34 and the 24 or whatever. Add those two together to get that total number. Remember when using that sheet. So cost of production, anyways, that's a great way to benchmark yourself against other people. It's a good starting point, knowing where you're at, and that really sets you up for success later on when setting up your marketing plan, because without that number, it's very difficult. And I also want to say, use it as an opportunity cost as well. In this example, if I look at the land in the middle, I've got $274 allocated. If I'm an older producer, or if I inherited land, remember, if that number is technically a lot lower than that on an average for my operation, still use or try to use something in a normal ballpark range, because you could always rent out the land, remember. So it's important when factoring in what's my real cost of production, don't undershoot it because of your land cost. Make sure you're using a number that is actually market value. Let's look at production estimates, and this is an important one, because a lot of the time when I look at people and work with them for the first time, one of the common questions is, how do I sell something that I don't have yet? And that's a very important question to ask and go through. And we have to be comfortable with this concept of, I'm selling something for something I'm going to have in the future. You're going short that commodity. And I think this is important because when I look at a yield assumption, it's okay to be realistic. Tell yourself, when's the last time you had a yield under X amount? What was your lowest yield that you've had on a cornfield in the last 10 or 20 years? What's the trend look like? If we have a disaster, what's that actually going to look like for me? Once you take that number realistically, combine it with things like federal crop insurance that's subsidized now, it gives you a big advantage when looking at marketing. So remember that. Yield assumptions take into account what crop insurance gives you for protection. What's your historical averages look like? What's your APH look like? Keep a conservative mindset in both directions as well. If I'm planning on marketing my crop, have a realistic number in mind, because if I'm putting together my cost of production and I'm, instead of using 211 on my cost of production, I use something like 150, I'm probably not going to find a marketing level that makes sense for my business profitability wise if my yield goal is unrealistic. I'd be waiting forever and hardly ever taking advantage of good prices from a seasonal aspect. So we need to be realistic with our targets in that manner as well. And then obviously overestimating any yield increases, risk exposure. Just reminder to view your yields, your production data weekly throughout the growing season. All right, now let's work our way over to expected revenue calculation. So when I look at just how that revenue is collected from a production standpoint, I'm going to be looking at an expected yield times expected price. Expected price typically starts with the future side. A good example to use for that would be something that your lender is comfortable using in your balance sheets or projections. Also aligning it with something like federal crop insurance price in the month of February. That average price is typically a good parameter of where to start your year out for the marketing season. That gets benchmarked across a lot of different marketing strategies, as well as that also provides a floor at a certain point for your operation. So revenue expectations do change with market timing as well. When I look at when I look at the next item in our list, it's going to be logistics. So, when I look at our priorities here for logistics, I just want a reminder that when I make out or build out a marketing plan, one of my first questions is, what do your logistics look like? Because I can't plan to store corn or make sales or take advantage of carry or basis, things like that in summer months if I have to deliver everything at harvest. The other thing is, we're talking a lot in this early stage about should I plant, in this example, corn or soybeans? Well, if my operation can only handle X amount of acres of corn, it's going to be difficult to maybe vary those acres too much. For example, the folks I work with in North Dakota, they would like to plant more corn acres. However, logistically, it's going to get pretty tough, not just because of equipment, but simply because their seasons change a little bit differently. They could get snowed out earlier. They may not get in the field as early. So, with all of those examples being the case, I really think that logistics play a big part in marketing. The thing is, you have to build your marketing plan around those logistics and keep it in mind. So a big one for me is time and labor with planning decisions. Equipment, do I have the capabilities of harvesting X amount of corn acres, or am I pretty stuck in a rotation? Then I can maybe can't do too much about it. Storage, does it look better to have some bins at home or build a bin, or do I continually take corn to town or soybeans at harvest? Rotation, all of those things feed in logistics, but also logistics around one, fertilizer application, if we put it down in the fall or not, and then two, cash needs. It's important to know that I've got X amount of expenses coming up in March with rent and seed costs, things like that in the spring and early winter. With that being the case, a lot of folks will have to sell grain to help pay for that, or would like to, so they don't have to extend their note out further. That's important because I don't want to make a marketing decision based around those logistical cash needs. So always keep that in mind. And if I am going to have expenses coming that I'm going to know about, I want to have that in mind in marketing so I know that thing is coming down the road that I have to prepare for with the strategy. Let's talk about corn versus soybeans planning decisions. When I look at the corn versus soybean ratio, so this is just if you took corn, soybeans divided by corn, what's that number? Historically, it's right around 2.3. Soybeans are 2.3 times greater than corn normally. If I look at odd years, right now is kind of an extreme example like I have up on the board. Soybeans are quite favorably priced compared to corn. Now we're in the back half, middle of summer, sitting here, so it's pretty tough for us to go out there and plant corn whether we want to or not today, so it's a little late, but it is important to remind ourselves of what the psychology of farmers is. And our bias is towards planting corn almost every year. Now, this also takes into account not just last year, but some averages. We typically will increase this ratio. Corn normally will be a little bit lower priced than soybeans by the end of summer compared to the beginning of summer because we like to plant corn in the United States. It seems like even if the math isn't working in the best way and it's saying you should plant more soybeans, we just end up planting more corn typically. And this is an example of it because this year we've been pretty much every moment since post-planting, soybeans quickly realized we don't have enough acres versus what our balance sheet looks like. And it was found out right at about the end of May that we really started to realize that decision, got better China news, all the things. But nonetheless, that's a very simple trend to follow most years. And that can tell us something historically. If you're at a 2-5 relationship where soybeans are 2.5 times greater than corn and it's January, and you decide, you know what, I am going to plant more of a strict rotation. I'm going to do more 50-50. I'm not going to do as much corn on corn this year. It's a reminder that if I make a decision on this, to plant more acres of one crop than the other, I better be marketing that accordingly because that will change later on in the year to say, hey, maybe it was the right decision to do that in January, but now in June on, it was the wrong decision. So always market accordingly if you make that switch. When I look at the acreage decision step by step, I want to start with what are the defensible yields. Reminder, if you do corn on corn, you take a hit. Typically, build out an expected cash price, futures and basis. Someone up in North Dakota, for example, the last year, it was a pretty tough situation because we didn't have any China business. So basis on soybeans was really poor at harvest, actually. So taking things into account for that as well. Or maybe harvest basis is really poor in your area for soybeans. So if you have to deliver something at harvest like corn, might be a better option for you. Plug in your true cost. And by that, remember, they change. Corn following soybeans is much different than corn following corn. You have higher costs on corn acres than you do corn following soybeans. So keep that in mind when making that switch as well. And then compare your margin per acre between the two. Really stress test it. Just try to really put a number to, is it in my best interest to make a switch on acres or not? And then logistical needs, obviously. Some of the things that can move this soybean to corn ratio, when I talk about the competitiveness for acres, typically we really like to plant corn acres in the United States. So over time, that does seem to have a pattern that the soybeans are a little bit more expensive compared to corn by the back half of summer most of the time. Also, another influence is just weather. The premium on weather normally is taken out a little bit earlier on corn because July matters more on corn weather. August matters more on soybeans. So the seasonal's a little bit differently there as well. So keep a few of those things in mind when looking at the corn versus soybeans acreage decision. And then what does crop insurance give you as well? The protection it gives you, is it more beneficial P&L wise to do one crop or the other? That may influence your decision. When I look at a few different examples of just corn cost to production, this would be a very simple way for me to try to break it down for you. Corn on planting decisions. So let's say, should we plant corn or soybeans in this scenario, given our numbers? I'm going to throw up there using 461 corn futures, very close to the crop insurance price given to us this fall. That harvest basis would be around 50 under, which would be a normal harvest time basis, kind of in eastern South Dakota there, kind of southwest Minnesota. Our expected cash price is 411 with that marketing opportunity. Planned yield would be 211, just like the Iowa State crop insurance cost of production sheet. My operating cost is $911 as well in that example. So with our expected revenue at $867 an acre using 411 and 211, cost of production at $911, I'm losing about $45 an acre with that expected scenario. My break even's about $432 cash there. So the margin's pretty tight to a little negative. If I wanted to yield my way out of it, kind of in this scenario, I'm going to have to get a yield above 220. That kind of pushes me closer to a break-even level, just for what it's worth. Otherwise, I got to be above 432, probably about a 20-cent rally there. On the soybean side, let's use 1194. We've been trending a little higher on the soybeans here throughout the marketing season after setting the Feb average price at 1109. So in this example, with an 80 under basis, 1114 on the expected cash price. We're planning on 61 as a yield, $679 at operating cost, just like Iowa State. In this example, we're pretty much at a break-even level using those scenarios. So in these two examples, if you're going to lose $45 an acre on corn, break even on soybeans, you could tell yourself, what one can I yield my way out of the problem of easier? Logistically, what one works better for me? But if all that matters is just P&L, what number am I going to use? And I got to choose to sell it today, I'm probably going to say on the soybeans this time, it's going to be the clear answer to keep a few more acres over there instead. Let's talk about, before we make any risk management decisions, one of the things we have to gauge truly with one another, which is risk tolerance. And when I view risk tolerance, it can be very different between two producers who are in the same exact situation. Let's say I have a producer who's in a situation who's very well off. They have a very good land equity built up. They have cheaper rent, well into their 40s, 50s, 60s. Not much risk to really manage, you would say. It would have to go very, very wrong for them to really screw up a marketing year regardless. And then in the other case, you may have a neighbor from them, same age, same situation, let's say, exactly financially, very similar land base. Just because those two people are in the same area, same financial situation, doesn't mean they're going to look at risk management similarly. And neither one may be wrong. The one, let's say, is going to be very risk off. The moment they hit their numbers of expected revenue, they take risk off the table because that's what helps them sleep at night. Knowing that they've protected the unknowns, that they're not going to take a bad year, even though they may not take advantage of some of the good years. The other guy, maybe willy-nilly, I'm just going to be bullish all the time. I'm not going to take much risk off throughout the marketing year. They can afford to take the risk. So they're in the same exact situation, but they just emotionally, they want to look at the situation two different ways. Knowing your risk tolerance is going to be very important because regardless of your financial situation, you need to do what you're comfortable with from a risk tolerance strategy. And that influences not just when you make sales, but how you make sales for your operation. Now, when I look at risk tolerance and how you go about managing that, one, I look at this chart. It's going to give me what the most bearish situation is, which would be negative. Like I want to take risk off the table. I want to make sure I don't have a bad year. What's the most bearish thing I can do? Sell cash grain, sell futures, that type of situation. What's the most bullish thing you can do? Well, normally it's nothing. You kind of buy futures on top of it, a Texas hedge, something along those lines would be more of the most bullish thing you could do. In the middle of that is typically an option strategy. So knowing your risk tolerance is very important when we start to look at how you go about managing a marketing plan and executing on one, because one of the best ways to execute on a marketing plan is to finish it, follow through with it, and not bail on it halfway through the year. So let's look at the onboarding process. We've determined what type of risk tolerance you have that you're comfortable with marketing. Let's look at some of the first things we need to line up in this step of creating a marketing plan for your operation. I'm going to try to get quite detailed on this. So the first thing would be onboarding. When I fill out our ProAg Power, our portfolio for your operation, what I'm going to need from you is things like what acres are you going to have this year planted on corn and soybeans? For those corn and soybeans, what's normal APH and how wide do you vary in yields? Crop insurance on both, what are you going to go with? 80% multi-peril? Are you going to do things like SEO, ECO? We have calculators built in our online profiles for you that can help show matrices of how that would turn out for you revenue-wise. Look at expenses, not just your own that you put together, but benchmark you against the Iowa State numbers as well that we put on our website. Expected yield for corn and soybeans, use APH maybe if you want. Otherwise, what is the expected yield you actually think you'll get this year? And then what are we going to use for an expected basis on corn or soybeans for either both harvest delivery or anything you put in the bin later on to keep advantage of? And then last but not least, any cash sales you've made, any HTAs, things like that that you've already made for this next marketing year. So the how-to list, when I look at just building a plan out, this is my priority list from top to bottom. I start with, let's figure out your cost of production. Let's look at your production estimates next, what acres and yields you plan to have, how many of those are marketable bushels, maybe you have share crop, things like that. What are you going to feed out of those bushels? How do you want to manage those feed bushels? And then next would be crop insurance. What protection do you have on those bushels that you are going to produce or not produce? So what revenue guarantee do you have in crop insurance? Because that gives you a benchmark. That gives you a baseline for your first step of big coverage moves normally throughout the marketing year. And then marketing priority list under that. This is a little bit more of where it's an art, I would say. I probably look at this very differently from the next guy. But in my opinion, this is what professional ag marketing does best and how we can help separate ourselves from other companies, and that's marketing priority list. I'm going to view profit first. If we hit our numbers that we want, we have to take risk off the table. Remember, how we go about it is a different situation, but once we get to a certain profitability level, what percent do we need to take off the table? That's priority number one. What phase of the cycle are you in stage two? Are you in equity preservation? Are you in a very, high ending stocks? We can't get out of this drought or this drudge of low prices and big crops in the United States? Are we in that cycle, or are we in ethanol expansion era? Boom, droughts everywhere, very volatile prices. The cycles normally range somewhere around 7 to 10 years throughout row crops. Now, when I first started row crop farming, my banker had told me he learned from the man that he spent time with early on in the bank that the bank always figured you have a year of six. You have 2 years where you break even, 2 years where you lose a lot of money, and 2 years where you make a lot of money. And that was kind of the normal cycle. So when I look at row crop farming, it's a commodity. It's not something that we're going to have X amount of sales, X amount of price every single year, and it's very consistent, and we just kind of follow a normal business model. Not at all. We produce a commodity that's vast everywhere and is influenced by weather and geopolitics from across the globe. Our yields are very variable for what we produce, and we have very incredible volatile prices that we do not get to predict or set. So, with that being said, remember the cycle that you're in definitely matters. And then that helps you decide what type of risk tolerance you want to have through that stage. Seasonal is a big one because if my profitability levels that I want aren't hitting by a certain time of the year, I know that seasonals really have a hold on commodity marketing price, and I have to take risk off the table just to protect myself at certain times of the year. And then how do we go about that? So I'm a big seasonal guy. Next, after that, after quite a ways, I would argue, kind of towards the bottom of the list, these influence all the other things, but I want to look at things like fundamentals, technicals, what reports are coming out, more of a bias. And this can help, when I'm looking at a chart, make a day-to-day decision maybe, more intricate, more finite levels, not so much big picture. It's going to be difficult to really make massive marketing decisions from a macro level looking at a chart. I'm going to need to know more things about profitability, what stage of the cycle you're in, what do the balance sheets look like, things like that to really gauge more macro levels. And then final, we'll go through what a what if plan would look like in a marketing strategy. If we sold this amount at this price, how would that look profitability wise for you? And if it's by this time of the year, what percent would we want that to be? If it's by this time of the year later on, what percent would we want it to be then? Because we can't look back, but we can always look forward. And it's easier to build out a plan and try to stick with it if we know it. So when I break those down, let's look at cost of production. In our example I used on corn and soybeans from the Iowa State data, $911 of production, $679 for the soybeans. If I'm looking at a row crop situation with 1,000 acres total of 500 corn, 500 soybeans, I'm looking at about 100,000 bushels of corn and 30,000 bushels of soybeans. What crop insurance price do I have that can protect me in those situations? Well, this year we are looking at a $462 crop insurance price on the corn side for the average through the month of February. Let's say I had ECO, SCO, 80 or 85% multi-peril underneath of it. I'm pretty much covered one way or another from catastrophes under 95%. So that gives me an average protection on just price at $439. $439 at 211, I'm going to be looking at somewhere around $926 for a protected revenue on corn. On the soybean side, similar situation, $1109, 95%. That's going to give me a price floor around $10.50 that kicks in. At a 61 normal yield, I'm protecting about $642 an acre. So in both those scenarios, corn actually, it worked out pretty well this year on where price was kicking in at. Soybeans, it was a little bit low versus what it could be, but it bounced back pretty well on soybeans too, interesting enough. So when I look at what crop insurance told us, it probably told us to plant corn. Soybeans, we did that, and soybeans have rallied ever since. When I look at this, profitability is pretty slim. When I start to go through my checklist, there's not much money at those marketing levels to really be had. So profits slim with crop insurance if I'm relying heavily on that. What stage of the cycle are we in? We're kind of in this equity preservation cycle with a little bit of a powder keg potential, which we'll get into. From a seasonal aspect, I'm giving this video in July, so it's kind of crunch time. I want to know that we're running out of volatility summer weather wise kind of by the end of July here. Normally, I would say any pre-harvest sales I want made should be made by now. So knowing where you're at seasonally there, right now we're kind of at crunch time when I take this video. Fundamentally, we're sitting on a powder keg, like I said, kind of right now in this soybean and corn market, just for this marketing year in this example. If we have things line up just right, there's pretty good potential for soybeans and corn to run to new highs even this late in the marketing year. We've got a little bit of dry weather in the western corn belt. If China does decide to buy as many soybeans as they say they're going to, which now they've started to a little bit, the soybean balance sheet could be very, very tight, especially if August weather is a little bit on the dry side. So with that being the case, it doesn't take a lot of problems on the supply side to put us in a pretty tight situation fundamentally. The problem is you need a few of those things to line up to really make that a problem. So normally what occurs is we usually put a lot of premium in at the beginning or right before, and then once we figure out that, oh, we actually got a crop, we got key rains, the crop's out there, then normally we back off a little bit. So knowing the fundamentals, how they align with seasonals, what kind of cycle that provides you, at what profitability levels, kind of gives you all of the decision-making processes you can kind of go through. And then last but not least, if you're looking at, all right, what's the exact price I should take advantage of? Sometimes looking at a chart can really help you out in that situation. Say, oh, we're just shy of the 100-day moving average. I may have some good potential here to find some resistance at this X level, price level. That can make you help make certain decisions in marketing. So that's kind of a decent way of, I think, looking through this and saying, hey, these are some of the ways I can look at marketing to try to make a decision for my operation and kind of cover all my bases. And if it's, if I go through that example, I think you've got a pretty good track record historically. Now, last but not least on that, I've got technical and reports. I mentioned the technical things like 100-day moving averages are nice, Bollinger Bands, old lows on contracts, highs and lows, looking at it from a seasonal time frame as well, retracement levels. Those are some technical key things to really look at. But on that last one, I also mentioned reports. Now, some years you have pretty big volatility through some key reports. I would say WASDE reports and prospective planning and acreage reports normally move the market quite a bit. Week in and week out, we have things like progress reports that can tell us what good to excellent ratings are, what planning progress are. Sometimes that can move the markets, but it's not quite as big normally. The big ones, for example, would be like the one we're about to find in August here for a WASDE report, which normally you have a lot of differential between the July report and yields versus the August. So that report coming up typically is a good parameter of time, just knowing that that big market moving event is coming at us. If we're at or near levels that make sense for my business, I may approach that differently. So just watch out for that. When I look at our priority list, I wanted to dive in a little bit deeper. So let's start with the profit side. Why does margin come first? Well, revenue doesn't necessarily equal profit. Just because I planted corn and corn prices rallied, that doesn't mean that I get to take advantage of that full rally or yield potential, for example, because I may have higher inputs or I may have a yield drag. So input costs are largely known before planning, so it's always important to try to account for those when taking into things like planning decisions and what margin opportunities are there. Margins help determine things like cash flow. Lining that up, marketing around your cash flow needs in advance is a huge benefit. Ability to service debt and long-term business survival, just having a plan and sticking to it, those are very helpful. If in the long run, let's say in a 20-year time frame, maybe let's say not hedging any corn was the good opportunity. The problem was, what if you had 3 or 4 bad years in a row? Your business may not make it to the 20 years. So being able to take advantage of key marketing opportunities that can keep you in business and build your net worth over time is a key to survival in this industry. All right, now let's look at a quick crop margin formula, and that's going to be based on you have expected revenue minus cost of production. That's going to give you crop margin. Pretty simple. It gives you an opportunity to lock in profits. And I bring this up in this way because it's important to realize that even if I'm not at a profitability level I want, I may be running out of time seasonally to get that price rally I want. And remember, losing a little bit of money can still potentially help your net worth move up and keep equity preservation alive, because that situation can get worse than where you're currently sitting at. So just because it may not be where you want, you may get pushed into a situation to say, hey, I still have some risk I need to protect from here until where crop insurance kicks in. Maybe I use something else like options to protect that in between. When I look at a roadmap now, moving on from profit to seasonal, it's important to look at the roadmap that we've really put together at Professional Ag Marketing. I would like to view this from a 1-year seasonal, kind of working on the next. So when I look at the summer beforehand, before I plant that crop, it's important, let's say for the summer of 25, to look at DEES 26 and some of the sell objectives that we could be potentially looking at. Because normally a pretty good way to take advantage of next year's prices are to look a year and a half or so ahead of time. And that can provide some pretty good objective opportunities that can make sense for your business in the future. So that's where I'm first looking at managing that next year's marketing risk, is actually a whole year and a half in advance and just taking a look at it. So like today where we sit, DEES 27 futures is almost $5. A lot of folks would say, oh, that actually would work okay for my business for that December 27 crop, even though it's only the summer of 26. On the February side of things, once we get into the time frame of the year where I've kind of figured out what I want to plant, where I want to plant it, I kind of know what my cost of production is, let's look at and evaluate what crop insurance decisions can provide me, and for protection, what I should do there, what protection that gives me, which can help kind of base out a marketing plan, and then and how can that protect my future crop and provide any revenue and price protection. And that's big too, because a lot of times I'll base some marketing decisions off where we're at versus crop insurance. Even a normal seasonal, I would argue, is once you set the price in the February crop insurance year, historically a good spot to try to target would be somewhere around 25 to 30 cents higher than that crop insurance price. That's a pretty normal rally for us to achieve during the marketing year. So getting to be able to view that, use historicals to provide some context or back up your marketing plan is always helpful as well. Once we get to the summer, we try to take advantage of price rallies, look at next year's price for any of those objectives. And then once we get to about that August timeframe, I look at locking in basis for any bushels that I want to deliver at harvest, and look at spread opportunities as well. Normally by August, we kind of figure out what the crop size is. It usually can be a pretty bearish opportunity for us to put in lows through that time frame just pre-harvest, and that can provide opportunities on both basis if an elevator is worried that they haven't got enough bought yet and we're at a low price, and then two, spreads if widened out quite a bit during that time of the year when we potentially could be putting in marketing year lows, which would be a normal occasion. Then you get into harvest, you harvest the crop, and then you should already know what to do there based on what you've rolled, what you haven't, what you can store, what you have to deliver at harvest, and those decisions are pretty much made for you already. I talked about seasonals quite a bit so far, but normally when I look at a seasonal, I like to look between January 1st on through next harvest or so. And a normal seasonal would be, we worry about a crop when it's just getting planted because we worry how much of it's going to get planted. Then we worry about how that crop is looking. We build in a little weather premium. Maybe it's dry in this part of the world. What if I don't get a crop? I should protect prices that way from a feed input standpoint. So they protect, they buy, get worried about if we have a rally or not, or if we have a weather rally, something along those lines that leads to a supply disruption. If we don't have a supply disruption, which is normally about 8 out of 10 years, we don't have much of a supply disruption. We normally give up a lot of the hope or premium we pull out of the market there, as you can see, seasonally around that June to July timeframe. So on about June 26th, our normal seasonal would suggest whether it's 5, 10, 20, 30-year seasonals, just like you can see on the board there. The green, yellow, and pink would be your 10, 20, 30-year seasonals. Normally, there's a pretty big sell-off between that June and July timeframe through the end of the year into making lows, kind of pre-harvest there before we rally back a little bit. Very normal seasonals, very easy to understand those seasonals just based upon supply and demand and the potential disruptions and when those could be potentially coming. So yes, seasonals do matter a lot when it comes to commodities. The thing to remind us is that we don't use seasonals to pick a price level, and that's always important because picking a price level can be difficult. I use seasonals just as a parameter on time to know that when we're approaching July 4th, if I want to have something marketed pre-harvest, I know that clock is ticking pretty hard, that we should be making a decision there. Seasonals can help make decisions once margins are acceptable. And if they're not acceptable, but I'm at a time of the year where I feel like I need to do something and take risk off the table, then we need to look at opportunities that are still there in marketing, like options, for example, to take risk off the table or protect us, or is crop insurance giving me fine protection for what I really need? This can be used, seasonals, I'd say, to help answer things like, when do I price futures? When do I delay cash sales? When do I expect volatility to increase, kind of in the weather time frame, for example? Those seasonals, once you combine them with other factors like margin, insurance, what protection that gives you, and looking at basis and spreads, you can make really good, sound decisions for marketing after those. So let's take another look at just kind of when we apply those seasonals. One, pre-plant, kind of early summer, I'm going to be more willing to reward rallies, kind of late summer harvest. I'm expecting some downward pressure when supply comes around, more visible. I'm going to be looking at managing things like basis and spreads rather than price targets. Post-harvest, I'm usually looking at trying to separate things like basis and futures price from one another. That's like grain marketing 101. If there's any advice I can give you on this today, being able to separate those two decisions from one another is a fantastic way to immediately, overnight, impact your marketing decisions. And then use spreads to help decide when the right time is to add value to your operation or sell your corn or soybeans that day. So that can help give you a little bit of a gauge on, should I store this in the bin? Should I sell it today or should I wait? Seasonals, when you plug that into a marketing plan, you're going to want to know what your cost of production is and how much, what your margin targets are. Use seasonals to define kind of a pricing window, I would argue. Just when do you feel comfortable using seasonals to help make marketing decisions? And then choose tools that fit that season as well. If it's super, super early, if we're a year or two in advance from when that crop is going to be harvested, do I need a wider window? Do I need things like just options or just puts instead of taking a stab at a direct futures price in case my cost of production changes through that time frame? Remember to keep that in mind as well. And if it gets late enough in the marketing year and my crop looks great, you can feel a little bit more comfortable to use things like maybe just futures or cash sales, for example. And then take a weekly review. Remember to adjust your crop size changes, the prices change. Seasonal is a guide. It's not perfect timing, remember, and they change, and not all years are exactly alike from a seasonal. I mentioned basis. Now, when I say separate basis and futures out from one another, it's important to realize that when markets are rallying really hard, if it's my crop is starting to look good, but we're at the high for the year and we're making new highs and the market's really going up and I can make a lot of money at these levels, I'm probably not the only one. I'm not the only producer seeing that. I'm probably trying to take some risk off the table, making cash sales, making future sales. When that happens, the elevator becomes much more comfortable with their situation going into harvest, for example. So normally when price rallies, farmers sell a lot. What happens is the demand for their product goes down because I'm looking at a lot of sales coming into my elevator. Now I've booked a lot of my needs for this next fall. I can back off on basis. The farmer's been a willing seller, and now I can take advantage of that. Normally, the worst opportunity for basis comes in very early spring during a big rally, and then kind of harvest and gut slot harvest when you've got the crop coming in a big amount. And normally we overshoot or undershoot production by quite a bit. And normally we can undershoot cost production by quite a bit there. So just keep that in mind that normally the best time to lock in basis is when the price is the lowest and or they think that they're worried about getting a crop. And sometimes that can be a nice pinch in like August before the harvest because the elevator, for example, is sitting in a situation where, gosh, I've got to load some trains. I don't have enough booked. I really need to get a move on and get something going. So when I look at understanding basis, just a quick reminder of what that is. Basis is equal to cash price minus futures price. So basis is a difference between what your futures price is at the Chicago Board of Trade and your local cash price. That's the difference on basis. So you can have that be a positive or a negative in some cases. Driven by local supply and demand, basis is influenced heavily upon just your geographical impact right around your area. It's a very local situation. Basis very, very much so follows seasonal patterns as well, like we just talked about on one, do I have a crop? Am I going to have a crop? And can I protect that crop at a good price? And then final cash price depends pretty heavily on basis as well. So there are a lot of things we can't control when it comes to marketing. Being able to separate things out and control them independently, locking in basis when it makes sense for your business or area, locking futures in at a separate time when that makes sense, it helps a lot when making marketing decisions. That example, so like let's say December futures is at $5 and you've got a local cash bid of 470, that basis example is going to be a negative 30. So that'd be a great way to look at it. Just futures plus a negative basis of 30, that gives you your cash price. Strengthening basis, that's going to help a lot with short hedgers. Normally, if you're sold on the board, then you just have basis to manage logistically. After that, it helps a lot with making marketing decisions. Spreads as well, very seasonal. Like I said before, when the prices are at a low level, the market is trying to influence you to store that grain longer. So if it's October, for example, and there's a ton of corn around in the United States and the prices are really low, that market's going to tell you, you hold on to the corn. I don't want it right now. Bring it back in 6 months. Managing those spreads is important, though, because you want to take advantage of that opportunity. You want to be able to say, hey, I'll take that premium you're giving me later on in the year because by the time we get there, I know that we're going to have plenty of corn to go around still because we're sitting with that much right now. So managing futures and storage, very, very big part of marketing in your row crop business. I know we had an episode earlier where we were managing just basis, futures spreads, things like that, managing your space like an elevator. This is kind of where that ties back into. It's a big part of it. So managing your space like an elevator, not just gambling on bushels you put in, is a big part of our decision-making process too. So for example, in this marketing strategy, you'll be selling a lot of December futures in the month of June ahead of harvest. If you have to deliver it at harvest, you'll be locking that basis in hopefully around the end of July or August at good basis levels, selling that cash price, lifting those futures, and then being able to take advantage of that. Or is a market telling you, hey, I've got plenty of storage, let's roll that futures short and D's further out to something like July and wait for basis to get better after I put it in the bin. Fundamentals. Let's talk about the next stage of this, because what are fundamentals? I would say if I had to use a mathematical equation to sum up what a fundamental is, it's really just price equals supply plus demand plus weather plus money flow. That kind of gives you all you need to know about price. What makes price? What derives price action? Those are the main fundamentals that influence that price on being where it's at. A few of those things being, one, the balance sheet, the WASDE reports, when they come out, that influences price greatly. That's strictly just supply and demand in the United States and globally. Weather influence, what does a forecast look like? Is it dry in the United States on the drought map, etc.? We're in a very, very heavily influenced just supply and demand and weather market in commodities. And then technicals. What do the charts look like? Are we making new lows, new highs? Do we have building momentum? Something for traders to really latch onto. Geography matters as well when I look at just where you're at fundamentally in the Corn Belt. So when there's a crop problem, let's say in Illinois, you can really reflect that and seeing that known on the river market. Or if the river is low, for example, it's hard to export corn out of there. So fundamentals do align well with geography. Where the crop is short in the United States influences price greatly. If Chicago, for example, is having really rough weather, it's dry in Illinois, they have a poor crop, that's going to influence prices more than something in North Dakota, for example, just based upon who grows the majority of the crop and kind of who needs that majority of the crop from that area. If we grow something in an area where nobody can really get at it or want it, that product's going to be worth less. When I look at global fundamentals, those matter as well, with things like Brazil growing their production greatly. So that matters as well. And then fund money flow. A huge driver of prices typically. What are the funds doing and why? Row crop risk tools. So now that we've learned kind of how we go about looking at our risk management practices, how we go about managing row crop marketing risk, let's talk about how we do it. The one would be crop insurance. I'm not going to get through this too much because I know Lucas has beat it up quite a bit, but on the crop insurance side, when I look at what protection does it provide me, that leaves me a floor. And that's important when you tie that into your marketing decisions, because if my floor on soybeans, for example, kicks in at $10.50, I know that I have risk on price basically on the majority of my production or revenue until that price. So look at what revenue guarantee, what you are from crop insurance, and what price protection that gives you as well, and what slippage there is there. Cash contracts and HTAs, those can be another row crop marketing tool. The how would be, I want to be pretty certain on what my production is going to be by the time I use things like cash marketing tools. I better have a crop, and it better look good, and I better not do too much of it so I don't come up short, for example. But it's a good way to take advantage of a good price when it's provided to you to a good location. Futures hedging is the most efficient marketing tool you can find. It keeps you a free agent. It keeps you insanely protected when it comes to price movements. That is probably the most efficient tool going back the last 40 years, you could argue, when it comes to protecting price volatility and opportunities. Option strategies are great, I view, as a marketing opportunity in row crops. I like to use options when the price may not be where I want, but maybe the seasonal tells me I need to do something. That's where I'm going to really use a marketing strategy like an option to protect myself from downside or upside if I need it when it comes to price protection, if I don't love the price that I'm sitting at today, or maybe it's not the right time either. Basis and futures spread management. When I look at row crop risk tools, rolling your futures back and forth, managing basis and futures separately, those are two very easy tools to really use as block and tackle work, I view, when looking at row crop risk management tools. So just to break through those again, crop insurance, look at a foundation of your plan, really try to combine your crop insurance into your marketing plan and use the two of them together. If I'm, for example, buying up a lot of crop insurance, maybe I don't want to use a lot of options at the same time and spend money or premium on that. When I look at the example of using marketing as a tool when it comes to crop insurance, try to view it as a revenue standpoint, but also my yield, if it's looking pretty good, it's probably just price that's going to move that revenue target from here on out. So using that to your advantage works really well. Using marketing and insurance tools together can create a really solid plan. Cash contracts and HTAs, like I said, HTAs, you're going to need a location to take these to. You're not a free agent. You better come up with the bushels when you get there. Just don't do too much, but it is a nice tool to use when you know that I want to take it to this specific location and I like this basis or cash price or futures. That can be a big advantage as well. Futures are by far your most bang for your buck when it comes to historicals when taking advantage of good prices. They have the best track record. You just have to margin the position, and we can talk through that independently as well if you give us a chance. But margin is pretty cheap when you look at it in the long run versus what you're really protecting. Let's look at an example of a futures hedge. So let's say I sold December corn at 520 on the board. Let's say we did 10 contracts at 50,000 bushels, locks in a futures price, not a cash price. Let's say the price when we get to harvest is at 460 on December futures. So we fell a little bit. We saw a 60-cent decline in price. When I look at the local price at harvest, it's only 430. So the basis is 30 under that day. So I'm going to get 430 cash when I sell my corn to the elevator. I sold my futures at 520. I bought my futures back when I made the cash sale at 460. I made 60 cents a bushel on my hedge gain there to add back to that. My net outcome is 490 a bushel, 60 cents plus my cash price I got at the end is 490. If you look back a couple slides there, we sold initially at 520 on futures. We had a 30-cent basis at harvest. That gives me a 490 price per bushel. So it doesn't matter where price goes after I set futures. We know that whatever futures plus your basis is going to be, that's what price I'm going to end up with. So that a few takeaways on that is falling prices are going to hurt the cash market. Falling prices help the futures hedge that you put on. The hedge converts price risk into basis risk. Options, if I want to go that way and use one of those tools instead of just a direct futures contract on there, you could buy a put. That would be a very non-intrusive way of protecting downside price. You can sell a call. That adds options. That helps make that call put a little bit cheaper, but that's going to limit any upside potential beyond that call that you sold. That can be used together to create a window. This would be probably the second most common hedging practice that we use here at Professional Ag Marketing for our row crop risk management. But in this example, let's just look at a put. You're buying a $5 strike put for about 35 cents a premium. Market falls to 440. That put is going to offset some of those losses on that price. So when I look at the example in that scenario there, you're looking at a situation where you're going to be buying a $5 floor, and you've got a 35-cent put and that you bought, and the market's at 440. So the difference of that is 60 cents, but you protected it for 35 cents. So net out, you made about 25 cents on that transaction to add to your cash sale at the end. So the option is very non-intrusive because if it goes up, then you only lose the amount of money you spent on that put, and you get all of the benefit of that cash price being higher. So for a full corn marketing plan, for example, just to go through things, let's say your cost of production is $720 an acre. You want to make $150 an acre. Your revenue kicks in at 80%. Let's say, I want to price half of that crop of the expected production, let's say pre-harvest by July 4th. You write that strategy down, look for price targets that make sense for your business along the way, that give you a good price opportunity, let's say something like $800 or $900 an acre revenue, that's going to hit your targets for margin for what you're looking for. On the remaining bushels, let's say on the other half, you could protect that with things like options, buying a put, selling a call, something a little bit less intrusive, just in case price really runs away from us. Or let's say you don't come up with the bushels and you have crop insurance kicking in. It's always nice to have a little bit of flexibility there. Basis set post-harvest, once I got the bushels, it's a little bit easier to manage some of those. And then grain stored only if the spread justifies the storage. So if it doesn't make sense to store the bushels based on spreads, reminder, don't gamble on the price of it. Just try to manage your space like an elevator. So we finished up with our roadmap, kind of talking about how to build out a risk management program there. So just a few habits that I would argue that everyone should really go about doing when it comes to risk management. One, know your costs before making price decisions. Use a written marketing plan that you want to execute down the road if that hits. Separate things like price, basis, and storage decisions from one another, and then review positions regularly just to keep an eye on where you're sitting. Key takeaways: Row crop management really is margin management. Crop insurance can be enabled is a very nice decision-making marketing tool that you need to combine with it. Each and every year it becomes more of a marketing tool. So just doing what you've always done may not be the right decision when it comes to marketing. And risk tools are best when they're probably combined. Not just one tool is the best when I would view it that way. And then discipline's always going to beat prediction every time in the long run. So it's impossible to predict price. So have a nice strategy, have a nice plan to try to take advantage of that. So thank you for coming on the webinar today. If you have any questions about how to get set up and manage row crop marketing risk for your operation, give us a call. I'll get you set up in our Pro Ag Power. I'll get you signed up on Account Docs, and we'll make sure the marketing program fits towards your needs, not just what I think. So thank you for your time today. I really appreciate it. Please click the subscribe button down below, and please reach out to us if you need anything further. I appreciate your time.